The New York Times Company has been reporting the news since 1851, but the story investors are watching today is something far more modern. A digital subscription machine now generating nearly $3 billion in annual revenue.
Founded by Henry Jarvis Raymond, the Times struggled early. That changed in 1896, when Adolph Oakes bought the paper for $75,000 and coined the motto, "All the news that's fit to print."
The company went public in 1970. For decades, it was a print-first media giant. Then the internet arrived, and the Times faced the same existential question every newspaper did. How do you charge for content rivals give away for free?
Their answer came in 2011, a digital paywall. Industry skeptics predicted it would collapse traffic. Instead, it became the blueprint every major news publisher eventually copied.
Today, the Times generates revenue from 4 streams. Digital subscriptions at 38% of the total, print subscriptions at 22%, digital advertising, and a growing set of standalone products.
The 2022 acquisition of The Athletic for $550 million added a distinct sports journalism moat. The Athletic now carries roughly 3.5 million subscribers of its own.
Then there are the games, Wordle, Connections, Spelling Bee. These viral puzzles have become a subscriber acquisition engine, unlike anything the traditional media world has seen. Casual players convert to paid subscribers at a meaningful clip, with essentially no incremental content cost.
Gross margins run near 48%. Operating margin has reached 16% as digital scale absorbs fixed newsroom costs. The balance sheet is debt light, under $50 million in debt against $255 million in cash.
The Times has raised its dividend for 6 consecutive years, now paying 60 cents per share annually. Yield hovers near 0.7%. This is a growth company that also returns capital, not a high-yield income play.
In 2019, the annual payout was just 24 cents per share. By 2024, it reached 60 cents, a 150% increase over 5 years, funded by expanding free cash flow as the digital model scales.
On the competitive map, News Corp's Wall Street Journal targets business readers. The Washington Post targets political insiders. The Times targets everyone, backed by investigative depth, sports, games, and cooking. That breadth is both a strength and a challenge to sustain.
The digital subscription network now reaches over 10.7 million paid subscribers worldwide across nytimes.com. The Athletic, Games, and Cooking. Each product feeds the others, a cross-sell flywheel built on editorial excellence.
Leading this transformation is Meredith Kopit-Levien, President and CEO since September 2020. She joined the company in 2013 as Chief Revenue Officer, building the commercial infrastructure that made the paywall viable.
A Duke University graduate, Levien came from Forbes with a revenue strategy background, not editorial. That lens has defined her tenure. Grow subscribers profitably, diversify revenue, and keep the newsroom independent.
Q1 2026 results are in for the New York Times. Whether digital subscriber growth held momentum, how ad trends shifted, and what guidance looks like for the year, all of that is in our earnings episode. I'm Hudson Thomas for Charged Alpha. The New York Times reported Q1 2026 revenue of $712 million, up 12% year over year and beating estimates by 2%. Adjusted EPS of 61 cents crushed the 47-cent estimate by 30%. Digital advertising surged 32%. Digital subscribers reached 12.5 million. The stock jumped 7%. This is Charged Alpha. I'm Hudson.
And I'm Lana. The New York Times operates the leading subscription-based digital news brand in the United States. Revenue comes from 2 primary streams: subscriptions, digital and print, and advertising. The company has transitioned from a print newspaper to a digital platform with embedded lifestyle apps including NYT Games, NYT Cooking, and Wirecutter. Market cap is approximately $13.3 billion.
CEO Meredith Kopit-Levien has led the Times since 2020, driving the pivot from print advertising dependency to a subscription-first strategy. Levien's stated goal is reaching 15 million subscribers by 2027, a target that requires continued net adds at or above current rates. Her strategy centers on bundling lifestyle apps with core news to justify premium pricing and reduce churn, as the Times competes directly with streaming and other subscriptions for consumer wallet share.
The New York Times reported Q1 2026 revenue of $712 million, up 12% year over year, and beating the $697 million estimate by $15 million. The revenue beat was driven primarily by a 32% jump in digital advertising, significantly outpacing expectations, offset partially by print advertising, declining 9.8%.
Adjusted EPS of 61 cents beat the 47-cent estimate by nearly 30%, one of the stronger EPS beats in media this season. Net income was $87.9 million. Adjusted EBITDA was $111.2 million, with a margin of 15.6%. Adjusted operating profit grew 27.2% year over year to $117.9 million.
Digital subscriptions reached 12.52 million, with 310,000 net adds in the quarter. Total subscribers, including print, reached 13.08 million. Digital subscription revenue grew 15% year over year to $389 million. The net ad pace of 310,000 was below the 450,000 ads in Q4 2025, a deceleration bears noted.
Digital advertising revenue grew 31.6% year over year to $93.3 million, the strongest digital ad growth in years. Print advertising declined 9.8% to $43 million, consistent with secular decline trends. The digital ad surge reflects Timbergomer, the Times benefiting from brand-safe premium inventory as advertisers diversify away from social media platforms.
The balance sheet provides strategic flexibility. Cash and equivalents of $650 million against total debt of $150 million creates a net cash position of approximately $500 million. Free cash flow in Q1 was $81.5 million. The strong balance sheet supports continued product investment, potential acquisitions, and the dividend, which yields approximately 1.1%.
The Times raised full-year 2026 guidance to digital subscription revenue growth of 10 to 14%, consistent with current momentum. Total revenue guidance was raised to 8 to 12% growth. Operating profit is expected to grow meaningfully year over year, with the full-year EBITDA margin trajectory confirming that digital operating leverage is emerging as subscription scale increases.
Analyst reaction was broadly positive, driven by the 30% EPS beat and the surprising strength in digital advertising. Bank of America maintained a neutral rating, reflecting the stock's premium valuation at 37 times earnings. Bullcase analysts highlight the subscriber trajectory toward 15 million and AI content licensing as underappreciated drivers. Consensus is mixed. Most analysts have hold or neutral ratings despite positive fundamentals.
The subscriber growth debate is central. The 15 million target by 2027 requires quarterly net adds near 400,000. Q1's 310,000 was below that pace. Bulls argue seasonal softness, bears flag saturation risk. The bundle strategy, combining news, games, cooking, and audio, is the key variable. Bundle conversion drives higher RPU, even as ads slow.
The digital advertising surge is the biggest positive surprise. Digital ad revenue growing 32% is well of the single-digit or low double-digit growth many analysts expected. The driver is NYT's brand-safe premium positioning. As social media ad trust erodes, marketers are shifting budgets toward curated premium news environments. Bulls see this as a structural shift that could sustain double-digit digital ad growth through 2027.
The AI angle is emerging as an investment thesis. The Times has filed lawsuits against OpenAI and Microsoft for alleged copyright infringement in training AI models. If licensing deals become industry standard, the Times' deep archive of journalism could generate significant recurring AI licensing revenue. Bulls model this as an 8-figure to 9-figure annual revenue stream by 2028, currently unmodelable but potentially material.
Valuation is the bear constraint. At 37 times earnings and 4.7 times revenue, the Times trades at a premium to most media peers. The bull case requires continued subscriber growth toward 15 million and margin expansion from digital operating leverage. If ads plateau below 300,000 per quarter, the premium multiple becomes difficult to sustain.
The bull case is the bundle model compounding. The Times has demonstrated that games, cooking, and audio convert subscribers to higher value bundles, lifting ARPU. As the bundle library expands, each subscriber becomes more valuable and harder to churn. Bull case models see revenue growing 15 to 18% annually as digital subscription revenue compounds and AI licensing adds incremental revenue.
Digital advertising inflecting at 32% is the most underappreciated catalyst. Legacy media companies have struggled with flat or declining digital ad revenue. NYT's brand-safe inventory is increasingly scarce in a landscape where social platforms face advertiser boycotts over brand safety concerns. If this shift is structural, digital advertising contribute 10 to 15% annual growth for the next 2 to 3 years.
Operating leverage is the long-term margin opportunity. The Times' content costs are largely fixed. Journalists, technology, and editing infrastructure don't scale linearly with subscribers. As digital subscribers grow from 13 to 15 plus million, incremental revenue flows more directly to profit. Bull's model margins expanding from current 12% toward 20% by 2028.
The bear case starts with subscriber deceleration. 310,000 net adds in Q1 is below 450,000 in Q4 2025, and well below the pace needed to hit 15 million by 2027. If the bundle is approaching domestic saturation, the 15 million target slips and the premium multiple compresses.
Print decline is structural. Print advertising fell 9.8%, and print subscriptions continue declining as older readers age out. The Times invests in the print product to retain a loyal base, but each print dollar earned carries high fixed costs that do not benefit from digital operating leverage.
AI litigation creates uncertainty. The Times' copyright lawsuits against OpenAI and Microsoft could result in settlements or licensing deals, but litigation is expensive and outcomes uncertain. If courts rule against the Times, the AI licensing revenue bulls anticipate may not materialize, removing a key bull case thesis component.
Competition from free news platforms creates a ceiling on growth. Many readers access content through aggregators and social feeds without paying. Premium pricing, the bundle starts near $25 per month, limits addressable market. International expansion is needed to offset domestic saturation, but monetizing global subscribers at US ARPU levels is unproven.
News Corp is the closest direct peer, operating the Wall Street Journal, Dow Jones, and News UK. Like the Times, it's transitioning from print to digital subscriptions with a smaller but growing digital sub-base. News Corp trades at a lower multiple, reflecting a complex corporate structure, including real estate and book publishing alongside its news properties.
Graham Holdings operates the Washington Post, the most comparable premium news brand in the U.S. The Post's subscription and monetization challenges underline how difficult premium news monetization is even for marquee brands. Graham Holdings itself is diversified across education and television, making it an imperfect pure-play comparison, but a useful bear case reference.
Paramount Global reflects the bear case for the Times. Legacy media companies that failed to build subscription models have suffered revenue decline and forced asset sales. The Times' premium multiple versus distressed peers reflects its subscription success and underlines the stakes of the 15 million subscriber target.
Valuation context. The Times at 37 times earnings commands a premium over News Corp at roughly 12 times. The premium reflects subscription quality and growth trajectory. Bull case targets of $85 to $90 per share imply re-rating on subscriber momentum and margin expansion. Bear case targets cluster in the 65 to 70 range.
The New York Times options market ahead of Q1 reflected moderate uncertainty. Implied volatility was below historical peaks as the stock had already risen on anticipation of strong digital subscriber data. Bulls had pre-positioned with call options ahead of the report. The 7% post-earnings jump suggests most upside was not fully priced. Bulls who established call positions captured significant gains.
Post-earnings, options shifted toward take profit on pre-earnings calls and new positioning above $85. The 7% jump was the stock's largest single-day move in over a year. Near-term call activity is concentrated in the 85 to 90 strike range, with bulls positioning for the 15 million subscriber milestone as the next catalyst.
Insider activity at the Times has been limited in recent quarters. CEO Levine and other executives hold equity compensation aligned with long-term performance targets. No significant open market purchases were disclosed in the last 90-day window. Consistent execution against subscriber targets is the most meaningful insider alignment signal available.
The combined signal from options and insider data is constructive. The 7% move confirms the market underpriced a 30% EPS beat. For long-term investors, digital subscriber trajectory and digital advertising growth are the signals that matter. The 15 million goal by 2027 is the North Star. Momentum toward it justifies the premium multiple.
The New York Times reported Q1 2026 revenue of $712 million, up 12%, with an EPS beat of 30%. Digital advertising surged 32%. Subscribers reached 13 million. Stock jumped 7%.
Bottom line, the Times is the only legacy media company that successfully converted to a subscription model at scale. The bull case is bundle ARPU expansion and AI licensing. The bear case is subscriber saturation and print headwinds. The 30% EPS beat is why bulls stay long.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.